Good day, everyone. I am Miss Jane B. Gelindon, and today I will be presenting simulation and modeling credit risk evaluation in banking and lending sectors using neural network model. Nowadays, people have become accustomed to borrow money or things that can be borrowed for many reasons, especially with lending companies, banks, and even in cooperatives and other financial sectors. What exactly is borrowing and why is it so prevalent? It is often the cause of quarrels, especially among relatives. How do we trust our creditors, or how do banks and other lending and financial sectors trust us to lend? Evaluating people in debt is very important, especially with banks and other financial organizations. Often, there is also a bias due to the emotions that people display. And another reason is that they do not provide the correct data in their loan application. Even though the financial organizations and banks are strict, there are still those who can get away with it. So often, the creditors are not well assessed, or they just based on someone's work and assets to get into debt. As a result, banks and financial organizations incur losses due to non-payment on time. These loans contain significant amounts of money, and their non-recovery can result in a significant loss for the financial institution. As a result, reliable risk assessment is critical for banking and other financial institutions. It is not always most effective, critical to reducing the risk of extending credit, but also to reduce errors in denying legitimate clients. This accurate assessment will protect the banks from legal actions. In this study, the researcher wants to determine if a person can get a loan through credit risk evaluation using neural network in Google Colab to be able to train and validate the model. Many researchers have already done this credit risk evaluation. In the previous experiment of the researchers, it is made with the aid of KangarooBPNN, a graphical user interface software, in order to find the mean squared error of a supervised neural network model. However, the researcher of this study wants to determine the accuracy of credit risk evaluation in simulation and modeling using Google Colab in neural network. The Google Colaboratory is also known as Google Colab. It is a free online cloud-based Jupyter notebook environment that allows us to train our machine learning and deep learning models on CPUs, GPUs, and TPUs. The German credit risk dataset will also be used in this experiment for credit risk evaluation. Through this, we can see the accuracy of the credit risk evaluation based on the dataset that was run in Google Colab using a neural network. It will also help the banking and other financial sectors to assess a person before they are given a loan and if they can pay on time. This is a big help to reduce the losses of a company, not only in the banking and other financial sectors, as well as in lenders of goods. So, to know the conceptual framework of this study, the researcher will use a common and balanced machine learning dataset known as the German credit dataset, or simply German in this project. The German credit dataset describes financial and banking details for customers, and the task is to determine whether the customer is good or bad. The assumption is that the task involves predicting whether a customer will pay back a loan or credit. So this data flow, the dataset includes 1,000 examples and 10 input variables, 4 of which are numerical or the integer, and 3 of which are the categorical. The input data set composed of age, sex, job, housing, saving account, checking account, credit amount, duration of the previous credits, and the purpose why the customer wants to take a loan. So these are the input layers. Then the hidden layers, this will work when all of these data will put in all these hidden layers. Then after the hidden layer, we will see the output layer wherein we will classify them into two. One is for bad customer or the disapproved, and two for good customer or approved. So for you to be able to get all of this, all the output layer, so after the output layer, the test the accuracy of the data set on the risk, whether a client is good or bad. So this will be the output layer, and then evaluate selected models to identify a good or bad credit. So some of the categorical variables, such as savings account, have an ordinal relationship, but the majority do not. There are two classes, as I have said, one for good customers and two for bad customers. So good customers are the default or negative class, whereas poor customers are the exception or positive class. 70% of the cases are good customers, whereas the remaining 30% are the bad customers. So the data set includes a cost matrix that assigns a different penalty to each misclassification error for the positive class. A cost of 5 is assigned to a false negative, classifying a bad client as a good customer, and a cost of 1 is allocated to false positive, marking a good customer as bad. This implies that the positive class is the emphasis of the prediction assignment and that it is more expensive for the bank or financial organizations to give money to a bad customer than it is to not give money to a good customer. This must be considered while choosing a performance metrics. And for the results and discussion, so first we have here the data preparation, which we download first the data set and save it in your current working directory with the name German credit dataset.csv, then upload it in the Google Colab. So running the dataset and confirms the number of rows and columns, that is 1,000 rows and 20 input variables and 1 target variables. So as you can see here in the dataset, you already recognize the risk, which is the good and bad customers. So it already applies the risk here. So the prediction accuracy is the most commonly used metric to classification tests in order to evaluate the model, although it is incorrect and sometimes dangerous, deceptive when used on imbalanced classification tests. This is because if 98% of the data belongs to the negative class, you can achieve 98% accuracy on average by simply predicting the negative class all the time, resulting in a score that naively looks good but in a practice has no skill. Instead, alternate performance metrics must be adopted. Popular alternatives include precision and recall scores, so which allow the model's performance to be evaluated by focusing on the minority class, known as the positive class. And the precision is calculated by dividing the number of accurately predicted positive examples by the total number of positive examples anticipated. Maximizing precision will reduce false positive. So recall predicts the ratio of the total number of correctly predicted positive examples divided by the total number of positive examples that could have been predicted. Maximizing recall will minimize false negatives. So the performance of a model can be summarized by a single score that averages both the precision and the recall, called the F measure. Maximizing the F measure will maximize both the precision and recall at the same time. So using the F measure, you can compute the harmonic meaning of precision and recall. This is a decent single number for comparing and selecting a model for this problem. So the problem is the false negatives cause more harm than false positives. So once the model is evaluated, we can report the mean and standard deviation of the F2 measure scores directly. So this is the result for the half measures, and we got 0.535. So when I built the model using the original data set, the precision to recall ratio was too high, and it means that the model misidentified a bad loan as a good one. So in terms of business, we designed the model to maximize profit while minimizing loss. However, in this case, the model's classification would increase the risk of bad debt, resulting in a financial loss for the bank. So the rationale for the model predicting a bad loan as a good loan is that the good loan to bad loan ratio was 70-30 because the values of a good loan were significantly higher than those of a bad loan in the target variable. I concluded that the model was biased and skewed toward the values of a good loan. So that's all. Thank you and God bless us all.